Hi again everyone, I hope you're all doing really well. I am back with another update on Xela Technologies, ticker symbol XELA or Xela. So in another surprising twist, Xela has gone back on its much touted stock buyback notes deal. Literally on the closing day of the buyback, the company backflipped on the notes and announced that instead of notes, the exchange deal is now going to be for preference stock with a 6% dividend rather than a 6% coupon payment, which will now be paid in perpetuity rather than through to 2029. So what does this all mean, and how does this change the nature of the deal, and what does it mean for Xela's common stock? Well, that is what we're going to be looking at in this video, so let's get straight into it. So here's the press release from Xela Technologies regarding the change from notes to preference stock. Key points include that the exchange rate remains unchanged, with 20 regular Xela stocks needing to be exchanged for a $25 valued preference stock. There will now be a perpetual dividend of 6%, meaning that the 6% payment will go beyond 2029, and the preference stocks will also be eligible for future dividends from the company. That is, of course, if they do pay out any in the future. And if they do, it is not clear if they will receive those future dividends in relation to the 20 shares that one preference stock is equivalent for, or if one preference share will receive the same dividend as a single common stock. The other bit of information that I need to look into further with this stock offering is how preference shares are treated in terms of voting rights. It's not uncommon for preference shares to receive either superior or inferior or even no voting rights at all. So further investigations needs to take place. The new shares will trade under the ticker symbol XELAP or XLAP. Interestingly, the CEO and board are indicating that they are looking to pledge about 28.5% of their holdings to the deal. Finally, shareholders now have until the 10th of March to commit shares to the deal, which is still before the company releases their Q4 financials, but now that the deal is for preference shares, I dare say this is no longer quite such an important consideration, as it would be if the deal remained a notes offering. Okay, so what does this all mean? Well, from a financial governance perspective, this is probably a sounder move from Xela Technologies, as it means they will now have more attractive books in the sense that they will now not have the potentially $125 million of longer term debt on their books, and the move still achieves the goal of reducing the outstanding share balance. However, with the caveat that they have now created a new class of stock. Having multiple classes of stock is a move that is not uncommon. One only needs to look at Alphabet, aka Google, to see an example of a business that uses multiple classes of shares. The key difference in Google shares is the voting rights assigned to the share classes, but despite this, the classes of stock tend to be priced at around the same point. However, in the case of Xela, the two classes of stock will be vastly different and therefore subject to different market pricings. Xela will still have to fork out up to $7.25 million to cover the dividends. However, this liability should not be considered one technically, as dividends are considered distributed profits rather than an expense to the company. Still, it is an extra $7.25 million that the company will be paying out, and when you consider they have not been profitable for the past few years, that is a little bit concerning. However, they were planning on paying this out with the notes regardless. So when comparing Xela and XLAP stocks, really XLAP looks like the more attractive option at this point in time, in my opinion. While I need to dig deeper to understand the key differences between the two classes of shares, particularly to confirm the underlying value and what voting rights are being assigned, if any, the XLAP preference shares still have a 6% annual dividend paid quarterly based off the $25 value, something that holders will receive even when the company is not going so well. And on the surface of this announcement from the company, the stocks will continue to have an underlying value of 20 regular Xela shares with preference rights in the event of a liquidation of the company. Basically, if everything has to be sold, preference shares will get paid out remaining sums of money before common stockholders of Xela. Now, if the preference shares are really assigned the underlying net value of 20 regular Xela shares, it will mean the hoped boost in common stock value that would have been achieved through the original buyback deal for notes will likely not be achieved. And it is for this reason that I think we have seen a bit of a negative action from the Xela share price since this was announced. And I think when XLAP stocks are listed, while they will float at $25, there will likely be some downward revision in their price to align with how the market sees what 20 regular Xela shares to be worth, as well as the additional $1.25 annual dividend payment. So basically, this new XLAP stock will not be priced like a debt instrument, but rather just another share on the market with different rights to the other Xela stocks available. Anyway, my on-the-surface reaction to all of this is that this move goes further to improving the Xela books by avoiding them having to contain their new long-term debt and eventually having to pay out that $125 million in 2029. For those who are looking to get their hands on the notes, this would be a bit of a disappointment as the $25 face value will now not be realised as there is no expiry date to the preference shares. This latest revision of the buyback from Xela really has me scratching my head. The board could have easily achieved a reduction in outstanding shares through a reverse stock split. Perhaps it is a sign that Xela were unsure of their ability to meet the $125 million obligation they would have to face in 2029 when the original notes were set to mature, or it could be a sign that they were not having as many shares tendered as expected, so were looking to change the deal. Anyway, I still need to dig deeper regarding the rights of the preference shares as well as their underlying values. I also don't know if I get the option to renege on the shares I have already tendered for the notes now that the deal has changed. So this last minute move really does raise a whole bunch of new questions that need answering. Hopefully I will be able to find some answers for you all soon. This video was very much just a preliminary take on this somewhat radical update to the original notes offering. Anyway, what are your thoughts on the Xela preference shares? Does this make the deal better than the notes, or do you think this is a negative move from the board? Let me know your thoughts in the comments below. On that note, I've just got back from a week in the wilderness, cut off from all the craziness that has been taking place, so I'm sorry about the irregular postings. I do have still one more week of moving around ahead of me before I'm able to get back to having a bit more of a routine around my postings on this channel. So thank you to all those who have stuck around, and I look forward to bringing you some regular content again quite soon. Until next time everyone, may the markets trade in your favour. Cheers.